Hello everyone, and welcome to the Quantpedia Explains Trading Strategies video series. Today, we will talk about an analysis of quantitative strategies for country valuation.
Hello everyone, my name is Radovan Vojtko, I'm CEO and Head of Research at Quantpedia. Today we will discuss country strategy, so the strategy that picks country ETFs and tries to find the best for the next period or investment. We will discuss value strategy, so it will be country value picking strategy. Or the name of the article that we will be discussing is the analysis of price-based quantitative strategies for country valuation. That's the article that was published a few days ago, and I will try to show you our journey, how we try to come up with a new idea for evaluation of the countries. We try to improve the existing strategies. Now, this video will be interesting in a way that we will show you what are the risks of the quantitative researchers or what are the risks of anybody who is trying to build a new trading strategy. So you may have an idea, you may do the best to develop the strategy based on that idea, but sometimes the original strategies are better than the idea that you have. And I will show you how does that exactly look like, and I will show you, of course, the original strategies and original ideas on which we try to build our own valuation methodology. But firstly, something about the country picking, how the country picking strategies look like. So there are a lot of ETFs that are traded on financial markets. Those ETFs usually contain the stocks from individual countries, and you can get very easily the exposure to individual countries by buying those ETFs. It can be all of the developed, interesting countries like Germany, France, Japan, of course, United States, Canada, Australia, whatever, or it can be any emerging market or a lot of the emerging countries like China, India, Malaysia, etc., etc. So I mean a lot of the countries. So it's a very easy way how to get an exposure to international stocks. What is the value? Value is strategy that started as an investment strategy in the stock market. The investors try to beat the stock market by looking for stocks that trade price that is below their intrinsic value or book value. Value investors do not believe in efficient market hypothesis, so they believe that the prices are not efficient, so you can buy stocks or you can buy investments that have high interesting value, but the market price doesn't reflect that or doesn't recognize that. And when you buy something like that, and once the market starts to recognize the value of the business, the price of the stock goes up. The value investing is a long-term strategy. The Warren Buffett is famous for his patient and long-term approach of the value investing. He often buys stocks and he holds them nearly indefinitely, so I mean for a very, very long periods of time. If you are interested to know or learn more about the value, I mean we have two great articles showing the best performing value strategies, part number 1, part number 2. They are also in the description of this video, so you can take a look on that. Value strategies are not just for stocks. You can buy all of the other assets. So there are a lot of different definitions of what the value is and what is the cheap asset. It's very widespread in use in currencies. So we have undervalued, overvalued currencies. You can do it based on the PPP factor, purchasing power parity. Of course, in a country valuation, we will very closely discuss this. And also, for example, in diversified portfolio of assets in a general. So there are a lot of different variation on value. Today we would like to discuss the country valuation. I mean, the motivation for this study comes from the idea of simplifying the concept of relative valuation among the countries. So there already exist several ideas for relative value approaches that compare the visible price or market capitalization of some country or stock market to some unseen interesting value of the market. The idea we can use to measure the unseen intrinsic value of each individual country are numerous. I mean, there are a lot of them. It can be numbered from the GDP, like in the Buffett indicator. So the Warren Buffett is famous not just for picking the stocks, but he also likes to use fundamental value, which countries are interesting and which are not interesting for investment. He likes to use the market value of equity scaled by gross domestic product. That's his favorite indicator. If you are interested more about this indicator, we have a completely whole article related to that. Another idea is to use the total earnings of listed companies in the selected country and compare that to the market capitalization. So that's a Shiller's KP ratio. Once again, we have a strategy related to that. So it's called KPA effect within the countries. In this strategy, we have an investment universe consisting of multiple countries. We calculate the cyclically adjusted PE ratio, so price to earnings ratio for each country. We are going along the countries with the best PE ratio, so the lowest PE ratio, cyclically adjusted PE ratio, and we are shorting the countries with the highest PE ratio. Of course, the strategy works well, and what we try to do is we try to build a strategy that's not using this type of the non-price data like GDP or I don't know, earnings, demographic data, etc., yields, and all of that. And the reason for that is that it has a lot of advantages to use non-price data, because usually you can get a better model out of that. But the problem is that you need to have a source of high quality data for those non-price data for all of the countries. They must be published at times, because a lot of the time data, I mean, on GDP, demographic, yields, etc., or price to earnings ratios for individual countries are published with a significant lag. So we asked ourselves, can we create the relative valuation model and use just the price data? That was the question that we asked. All article and the rest of the video is how we try to proceed with that. So firstly, we used 20 country indexes, and we used simple price approach. So we averaged 20 country indexes into the average country index with equal weight, and then we tested multiple different definitions of the country's past performance or outperformance or underperformance using momentum, moving averages, and regressions. And we tested optimal sorting, rebalancing horizons, cutoff points, vigintiles, deciles, quintiles, so which part of the investment universe should we buy. And we tested multiple valuation methods using just the price data, so no economic data, no GDP data, no earnings data, no demographic, etc., just the price. So we downloaded monthly dividend and split adjusted data from Yahoo Finance for 20 countries, United Kingdom, Germany, France, etc., I mean, the mixture of developed and developing countries. We decided not to use the US, United States. We wanted to focus only on ex-US world. The reason for that is because US is around 50% of the global market capitalization. I mean, it doesn't make sense to combine US with all of the rest of the countries, because you have one country which is like 50% of the global market capitalization. So it makes sense to build a model comparing the US valuation to the rest of the world, but I mean, not the individual countries. There are models like that. We will not be discussing that at the moment. So, I mean, what is the attractivity of the US stocks compared to the rest of the world? We are right now dealing just with the rest of the world. So, I mean, if we decide to go international, invest into other stocks and other countries than into the US, which countries should we pick? So we started our backtest in 1992. Not all of the countries, of course, have data going back into 92. Most of the ETFs started in 1996 or, I don't know, 2000. So until 1992, we used the MSCI indexes that are freely downloadable from MSCI index website. We selected the standard, the large and mid cap size. So that's how we did it. Now, the value is long-term signal. So we already discussed that at the beginning. It takes a long time for the market to understand that, there is a spread between the valuation of two countries. So it means we should buy one country and sell another. So it makes sense to build a strategy that has a longer holding period. But if you have longer holding period, we need to use the trenching. And how does the trenching work? So let's take a look on that. So let's imagine that we have a portfolio and we want to hold that portfolio for 5 years. If we try to rebalance portfolio every 5 years, it would be a problem, because we have a very, very slow rebalancing period or very slow signal. So it means usually funds and people who employ trading strategies with a long holding period, what they do is they follow the trenching. So it means they divide the portfolio into multiple small parts, into tranches. They invest one part of the portfolio, hold it for 5 years, but they reinvest each small part every 3 months or every 6 months. So in this case, if you take example, so let's say that in end of 1997, we are trying to invest one part of our portfolio. So we divide our portfolio into 12 sub-portfolios. We would like to rebalance one sub-portfolio every 3 years, but we would like to check individual parts of the portfolio, individual tranches every quarter. In total, we have 12 parts of the portfolio, 12 tranches. So at the end of 1997, we invest the first tranche. We select 25% of the overbought. We go short on those countries, and we select 25% of the oversold countries, and we go long those one. And we hold this small part of the portfolio until end of the 2000. So for 3 years. So we have 3-year holding period for this one first tranche. Same thing we do 1 quarter later. So at the end of the March 1998, 3 months later, we select new stocks, we go long, we go short, but once again on 1/12 of the portfolio. And this 1/12 of the portfolio is held until 99, and after 3 years we did this once again. This way we rebalance every quarter one tranche of our portfolio, 1/12 of our portfolio. We do something like that 12 times during the 3 years. So every quarter, the small part of our portfolio has the most recent signals and the most recent stocks are bought. Our portfolio is significantly more diversified compared if we just rebalance once in 3 years. The whole strategy is more diversified, more stable, and that's the way how usually the strategies with the long holding horizon are built. So that's the trenching. Now let's move on. So what are the price-based valuation signals that we used? We used price-based moving average. We traded it as a reversal, so mean reverting signal. So we go along countries which have the price lowest compared to the 60-month moving average, and we short the countries where the price is the highest against the 60-month moving average. Then we use the past momentum signal. We go long the countries with the worst 60-month momentum, so the worst 60-month 5-year performance, and we short countries with the best 60-month performance, 60-month momentum. Last signal we tried was linear regression. We calculated regression of each individual country towards the average index that we built at the beginning, and then we use the intercept of the alpha as our valuation predictor. So we are buying the countries with the lowest alpha, and we are selling the countries with the highest alpha, and we are betting for the mean reversion. Now the question is, how much ETFs do we have in your portfolio and how diversified do we want to be? So we tested 1 versus 1, ETF 2 versus 2, so that's the decils, up until 11 versus 11 ETFs, or 10 versus 10, so it halves. We have over 20 ETFs in our investment universe. And what are the results? So the first and most interesting result is the impact of the number of ETFs in the portfolio. So we can show that example in a price versus moving average. When we move from the Vigintil, so we are all going long one ETF, we are shorting one ETF. So we can see the chart here. So over the last 20 years, we basically have zero performance using this valuation signal, price versus moving average, and just holding one ETF and shorting one ETF. Our portfolio is not very diversified, it's very volatile. But once we move to 11 to 11, we are holding diversified portfolio. We are basically holding the half of the countries with the lowest price against moving average and shorting the countries with the highest. Performance is much better. We have a stable equity curve. So diversification works not just by trenching, but also by buying portfolios with multiple ETFs. But even in this case, the performance is not very high, just around or over 1%. Of course, with a small volatility, a small maximum drawdown, but the total performance of the strategy is relatively low. I mean, it's the alpha, so it means it's long-short portfolio. So when you go just long, you can get part of the alpha in the long-only setting, but in the long-short, it's not very high performance. It's an interesting result, very similar to the general tendency of the value strategies to underperform in the last decade. There is a nice article called Resurrecting the Value Premium. It's not one article. There are a lot of articles over the last years that are showing that in the general, the value strategies are cyclical and they are from time to time underperforming. And the last 10 years were very hard for value strategies. Cumulative return of value strategies among the stocks in US, in developed ex-US, in emerging market, I mean, in all of the investment universes were very hard for the stock picking strategy that was using the value. What we are experiencing, or what we can see in our data, is that it's basically the same for ETFs. So when we are trying to employ the value strategy built on ETFs, we can also see that there was nice looking performance charts until around 2014, and then we have a flat equity curve or equity curve going down. That's not just in this case. It's similar for the case when we use the intercept signal. So when we use the intercept, so when we bet against the alpha, so we are buying the countries with the lowest alpha and shorting the countries with the highest alpha. We can also see that the performance of the strategies, especially the strategies that are using a smaller number of tranches, so 4 or 10 tranches, so there's 1 year or 5 year holding period for the strategy. The performance was looking quite fine until 2014, and afterward it was flat. Also the performance was maximally around 2.5%. That was for the base variation of the strategy. So once again, that's just the alpha. If we use this strategy in the long only setting, we can get part of that alpha as outperformance against the benchmark, but in the long short setting is not so strong performance. Once again, it's probably related to problems with the value strategies in general. Let's get back to it. Then we tried the past momentum signal. I mean, in the past momentum signal, it was hard to find out the strategy that was performing well. The past momentum is not a very good predictor in a valuation setting or for the valuation strategy. What are the final results? So indeed, it's an interesting thought process, but it did not yield expected results. So what we were expecting, that we tried to improve the existing KPI strategies, so cyclically adjusted price to earnings ratios, or we try to improve the Buffett indicator just using the price data. So we were not able to achieve that. One of the reasons is because as we are not using the non-price signals, we are not getting as much for the predictors as we could. Yeah, it's simpler than to use non-price. It's simpler to use just the price-based indicators, but we are not getting as much information as would be needed to have a better performance. There is another thing, and that's that it seems that the country ETF market is quite efficient. It's hard to find a reliable value long-short strategy that has performed well in the last 10 years. It's probably related to value strategies or the problem in general. And there are also other papers that are showing that it's very hard to naively pursue the premiums on the industry and country level. So it's easier to dig deeper into the individual stocks, so to pick the stocks, not to pick just the countries. There is significantly higher alpha when you pick the stocks, but from time to time, you as a portfolio manager, you have a mandate, you cannot do the stock picking, you must do the country picking. In this case, basically the two go-to strategies that you would start to test are valuation and momentum, so relative strength strategies. So I hope that you like the article. Hope that in case you are dealing with the problem to find out the good value strategy on a country level or good strategy to pick countries or do the international investing, that this video is inspirational for you. All of the links and all of the articles that I mentioned in this video, they are in the description, so feel free to read them. If you like us, please subscribe, give us the like, I will be very grateful to you. And I hope that you join me in the next video that hopefully will be ready in the next week. Thank you very much.
Interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.